good morning, Trinidad and Tobago, and welcome to the Bourse Report. Well, today we're switching gears a bit and turning towards the fixed income side of financial markets and taking a look at what would have been happening over the past couple of months, certainly in the first quarter of 2023. Now, fixed income is usually viewed as a less exciting aspect or asset class of investing, but it certainly has not been that way over the past couple of months. Let's take a look at what changes investors would have been facing and what they can expect in the coming months ahead. Now, when we look at the domestic side of things, firstly, one of the main drivers of market expectations and investor sentiment has been inflation, and locally inflation has trended fairly significantly upward or accelerated, in fact, since the start of 2022. In fact, as of January 2023, inflation would seemingly have peaked at around, or headline inflation at least, at around 8.3%, based on available data from the central bank. Preliminary data from the Central Statistical Office is suggesting that inflation may have in fact peaked, with March preliminary figures suggesting a decrease to just about 7.3% in terms of headline inflation. However, food inflation remains persistently high in the high single digit levels. Of course, not good news for consumers, and certainly a concern for investors, particularly focused on the fixed income aspect of their portfolios, given the inverse relationship between prices or values of fixed income securities as well as interest rates. Now, speaking of interest rates, despite this accelerating inflation, there has not been too many changes to the Trinidad and Tobago government yield curve, which is somewhat odd based on conventional theory. However, when we take a look at that 5-year point on the yield curve over a couple of time periods, we can see that there's not been too many changes. In fact, from December 2022 to March of 2023, there's been a 0.02% upward shift. So we're really fairly stable interest rates in terms of government yields at around that 4.08% levels. The same would have been observed on the 10-year point of the yield curve, with interest rates or yields relatively stable at that 5.18% level. The most notable change would have taken place at the shorter end of the yield curve, where on the 2-year tranche or 2-year tenor, for example, those yields would have increased just under 0.2% from 1.75 to 1.94%. So some changes at the short end, but generally a relatively stable government of the Republic of Trinidad and Tobago got the yield curve over the course of the past few months, and that has been somewhat of a challenge for investors, or one of the major challenges for investors continues to be, in the domestic side of things at least, access to government and non-government bond options, and we expect those to continue, or those features to continue, when we take a look at the local bond market outlook for the rest of 2023. Despite inflation seemingly having peaked, we do expect it to be somewhat persistent, moderating to the lower single-digit level in terms of headline inflation. However, a bit above traditional historical averages around that 3% level. And we do expect low interest rates to continue as inflation begins to moderate, 1, and 2, with the central bank's repo rate in particular being a policy rate aimed primarily in this instance at stimulating economic activity and unable to, or less effective in terms of controlling what is largely imported inflation into the Trinidad and Tobago economy. So we could expect, or in our view, we expect interest rates to remain relatively low going forward. Heading very quickly to the US side of things, US inflation has also started to trend lower. We can see that its headline number of the consumer price index inflation level would have peaked sometime in mid-2022 at 9.1%. The current level as at March is around that 5% level if we look at that yellow time series data. So certainly inflation is moderating and heading in the right direction, and that has in fact changed interest rate expectations for US-oriented investors after some fairly significant increases in terms of US Federal Reserve's benchmark interest rate, or the Fed funds rate, from 0% as at the start of 2022 to its current level of around 4.75 to 5% in 2023. There are increasing expectations of a peak in interest rates, or US interest rates at the very least, with some sectors of the market, or some observers anticipating that there may actually be an interest rate cut going forward. Now, how has that affected bond yields for US dollar denominated bonds? Well, when we take a look at some of the more familiar names in the Trinidad and Tobago space, or out of Trinidad and Tobago issuers in the US denominated space, for example, Trinidad and Tobago's government 4.5% bond, which is due in 2026, over the past 52 weeks, that interest rate or that yield rather would have peaked at around 6% and is currently trading at around 5.3%, heading back down towards its 52-week low of around 4.4%. How does that compare to US type securities or US government securities? Well, at the most right of your screen, we can see that US Treasury yields, the 2-year, in fact, would have peaked at around 5.1% earlier this year and is currently trading at around 4.2%, heading back down. Its 52-week low, just for context, would have been around 2.4% over the past year. So certainly, there does appear to have been some peaking in US dollar denominated interest rates. What does that mean for investors? Well, with moderating inflation, we expect inflation to be somewhat persistent, but again, having peaked, we do expect the U.S. Federal Reserve to approach peak interest rates sometime over the course of 2023, perhaps sooner rather than later, with other major central banks around the world expected to follow suit and have some peaking of interest rates. Will this lead to bond market stabilization? Well, that is the big question right now for bond investors, given that, yes, peak interest rates and falling interest rates eventually should help bond prices or bond values. However, there are increasing concerns about recessionary risk, and that could lead to some degree of credit quality deterioration, which we view as being a little bit more likely under the current circumstances. And that could throw a spanner in the wheel of bond market stabilization as we move deeper and deeper into 2023. So what does that mean for fixed income investors and specific opportunities? Well, for those investors that do want to fight inflation, at least partially, but do have some concerns or are lower risk oriented, looking at income mutual funds and repurchase agreements in both the TT and US dollar space is probably a good place to be at this current point in time. For those investors that are a bit more high or have more risk tolerance or high risk oriented and do want to take a little bit more duration risk and interest rate risk, you could look at investment grade bonds as well as speculative or non-investment grade bonds, both in the corporate and quasi-sovereign and even the sovereign space for a little bit more yield pickup, given that if your view is that interest rates have peaked and are about to head on their way down. Well, that's it for this week's report. For more information, you can give us a call at 226-8773, email us at invest@boursefinancial.com, or check out our website, boursinvestment.com, where all of our information and research is absolutely free. Stay safe, keep investing, and we'll see you next time on the Bourse Report.